Back with first trades, and we have been talking about the markets and some of the stocks that are reacting to their Q3 business updates. But let's shift focus, zoom out for a bit and talk about the macroeconomy right now. We have Mr. Rahul Bajoria, the head of India and ASEAN Economic Research, Bank of America Global Research, joining us on the show. Rahul, hi, morning, and thanks for your time. Lots of talking points. In your report, you've said that GDP growth is likely to be stronger in FY26 than we had previously anticipated. And on the back of that, you've raised your GDP estimate for FY26, and you've also modestly upgraded FY27 GDP estimate as well to 6.8 from your 6.5% projection earlier. What's driving this confidence, Rahul? Talk to us about the underlying factors that you're watching out for in the macroeconomy right now.
Sure. Good morning to everyone and a very happy new year. So I would say essentially it's an acknowledgement that the data cycle, particularly since the GST cuts have been undertaken, has been fairly strong and quite broad-based in the way it's been playing out. So we have seen a variety of indicators, whether it is car sales, whether it is credit growth numbers, whether it is fuel consumption, even mobility indicators. They are all starting to show a fair amount of positive momentum, both sequentially and relative to where we were a year back. And at the same time, the policy bias obviously remains relatively positive in the sense that it remains a source of support, with the RBI restarting its rate cutting cycle, doing a ton of liquidity injections, and then fiscal policy also playing its part. So I think all a real growth environment. What we have maintained is the fact that there will be a modest slowdown from the current fiscal year to the next fiscal year, which will partly be a reflection of the tax cuts phasing out to a certain extent. But then we are also anticipating the effects of the trade impasse between India and US to sort of start feeding into the trade numbers as well, which will be a bit of a drag.
Hi Rahul, good morning. This is Harsh here. Rahul, talk to us about what within the Indian economy are you most bullish about in terms of growth? Credit indicators have started to see an uptick, so we're starting to see good growth numbers clocked by the financials. Talk to us about the pockets which will likely outperform or contribute to this growth or this increased growth, if I can call it, that you are calling.
So Harsh, what we are essentially seeing is that consumption has continued to outstrip investment growth, through 2025, and my sense is that this trend will continue to a certain extent in 2026 as well. Now, one of the biggest challenges that we saw in the last couple of years was the slowdown in the nominal GDP growth side, but that also is likely to make a modest recovery in 2026, which should feed into urban incomes and in return also sort of help with discretionary consumption cycle, which we are seeing signs of strength in already. The other factor that we think will remain relatively supportive is the fact that government capex, after a period of relatively modest growth in 2024, in early 25, has made a very strong comeback. And I think with the project pipeline being relatively strong, you will see even if private capex remains relatively sluggish, public capex is going to remain more focused on execution and on implementation, which will provide a fair amount of support. This is visible in indicators around construction sector. This is also visible in our steel demand, in demand for land, etc. So we think that both these pillars are likely to remain quite supportive of the economy into 2026. Our sense is that the credit indicators, etc., also will provide a bit of a fillip, but they are going to grow within a certain limit. They will not have unlimited growth in some ways.
Okay, and Rahul, talk to us about the kind of demand that we're seeing in the economy. Now, on the policy front, we've seen GST cuts, we've seen the front loading of the rate cut also coming in, we've seen infusion of liquidity. So talk to us about how much of this growth that we're seeing in GDP numbers is actually because of policy support, and how much of it is being supported by actual underlying demand in the economy.
So if we look at the breakdown, I think supply environment obviously has been very, very supportive, which is reflected in the low inflation, which in turn has obviously boosted the purchasing power of consumers. But this year, 2025 was a year of recovery in aggregate demand conditions. I think, with the combination of both the two tax cuts, first the income tax cut and then the GST tax cuts, and then the monetary policy easing. I think all of it has kind of come together to support the aggregate demand picture, which is reflected in resilient investment and fairly strong consumption activity. Where it has shown up more within the consumption side is on the discretionary consumption side. So whether it is, say, demand for housing, demand for automobiles, a demand for travel, all discretionary line items, which have done very well. Our sense is that, over time, as the discretionary spending cycle sort of, starts to unwind, you will probably see that spilling over into consumer non-discretionary as well. Although, there will be limits to how much it can drive it. What has really helped, I think, has been very low food inflation, which obviously has boosted the consumption ability of especially our low-income and rural households. And so from that perspective, that has been a very, I would say a new feature in the last 2-3 years, relative to last 2-3 years that we have seen in last year. And this is likely to continue at least for the next 6 months as well.
Okay. Rahul, what within consumption are you most bullish on? Because you've spoken that consumption could well be the sector or pocket which could surprise on the upside. What would within that, it's very wide. So what within that are you most bullish on?
So within that, I think, in general, we like the auto space. We have obviously, after the GST, tax cuts, the affordability of automobiles, both from an upgradation cycle and from a first, car buyer cycle has been very strong. And this dynamic is likely to continue given the general guidance we are getting from car companies. We also continue to like the travel space. I think discretionary demand, particularly from the Gen Z consumers, has been fairly strong for travel and for, basically experiential spending, quality. And so from that perspective, I think that's another space which is expected to do reasonably well going into 2026.
Okay. And Rahul, talk to us about where do you see the next action coming in from the central bank, from the RBI. Another 25 bips cut is something that we've seen a month ago. 5.25 is where we are at on the repo. Do you believe, A, there is room for more rate cut, and B, if there is a case for any further rate cut required?
So I think there is a case for another rate cut in the sense that inflation still remains fairly benign in the current environment. And, while it is likely to pick up through 2026, we see it more as a mean reversion, as a normalization cycle, rather than any meaningful pickup in underlying inflationary price pressures. I think with, the external environment, particularly for commodity prices remaining supportive, we are unlikely to see any meaningful inflationary impulse from there as well. So the impact of a weaker rupee is not going to be felt. In such a situation with, still a relatively slowing path of GDP growth, but from obviously a high level, my sense is that the RBI does have space for one more rate cut in the February meeting, beyond which they can take a pause and, sort of assess the incoming data. But yeah, at this point, we are expecting a 25 basis point rate cut in the February meeting.
Rahul, golden question. So much happening on the geopolitical front. Your sense of what the impact could be. You, of course, have a great, a broad sight with regard to how things are playing out globally, whether it's tariffs or whether it's the Venezuela situation of sorts, if I can call it that. How is that likely to play out in 2026, and the impact of that on certain sectors, the largest ones at least? Give us a sense.
Sure. So I think we have been in a period of, fairly, I would say, uncertain geopolitical environment, which has had, multiple points of impact, both for India and for the larger region as well. I think Indian economy generally has been able to kind of, very deftly handle a lot of these shocks. The fact that oil prices have declined by almost $15 a barrel over the last 1 year in average prices has helped and cushion a lot of these impacts. And my sense is that that will continue to be the case. As a house, we are not looking for oil prices to be, meaningfully away from $60 a barrel, roughly where we are right now. So from that perspective, my sense is India does remain relatively well placed to deal with some of these shocks. I think the trade impact is going to be felt over a period of time. But even there, a lot of policy reforms measures are being also undertaken, which will help in at least mitigating, if not offsetting, a lot of these shocks. So from that perspective, we think that it will remain a period of relatively heightened uncertainty, but then we are also seeing the Indian economy exhibit a fair amount of resiliency to these shocks in some ways.
Okay, Rahul, appreciate that view, and thank you so much for your time today. On that note, we'll let you go. Viewers, time to slip into a very short break. We'll be right back with more conversations on the other side, so stay tuned.